So we're here with Keg Financial, Patrick and Tom, and we're just going to spend some time talking about life insurance companies, which is one of the verticals that we utilize for commercial financing today. So guys, thanks for coming on. And I guess my first question for you guys is, I guess sometimes when we're maybe new to this, we just think, insurance companies, that's where I pay my bill every month. But like, how does the whole life insurance company world work, and how does it, dovetail into this whole idea of commercial lending? So maybe we can start.
Sure, no problem. So let's just take an example of Dave's life policy for his kids. He sends in his hundreds a month or whatever his payment is, but let's use 100 for an example. The life companies take that payment every month, and they have to offset the liability of Dave's policy. God forbid he should die, that pays for his kids' education and his wife's support. Life companies typically are extremely conservative with that investment process because they need to have money in 50 years or 30 years or 10 years. So their investment horizon is extremely long. Because of that, they're used to very conservative and low yields. A typical life company puts about 80% of that dollar into corporate or government bonds. They have huge bond departments that every day are buying and selling highly rated corporate bonds or U.S. government bonds. Because those yields on those bonds are very low, they need something that kind of pops their yield a little. And for a life company, a pop in yield is almost laughable, but in their world, 50 or 100 basis points might be something significant to that life company, especially when it's looked at over millions or billions of dollars every year. So about 20% or 20 cents of that dollar would go into commercial mortgages. And they've been doing this for 50 years. It actually started they did farm loans when there wasn't a lot of commercial real estate. And so that's kind of gone by the wayside. So now they focus almost entirely on commercial mortgages. The goal of those commercial mortgages is to find very safe, conservative borrowers and product to invest in. And so because their investment horizon is very long term, they're not interested in construction loans or reposition loans as a general rule. They love 10-year loans, 15-year loans, 7-year loans. So they really don't compete with banks on 3-year money or 24-month money. Anything short-term in nature, they just are really not that interested in. Anything else?
Yeah, no, that's good. That gives sort of a good snapshot. And then most life insurance companies, because they know how to invest premiums, they sort of choose to disperse through local correspondents then. Correct? So like you guys are a correspondent for the life company, so you represent them in the market, essentially.
That's correct. So the way that they do that, Dan, they find that asset is, and it's not every life company. Some of them are direct. There are life companies that you can call that are direct, but a good majority of them use what's a kind of an industry standard called a correspondent agreement. And they basically write a contract with Keg Financial or another mortgage company who will originate and then service that loan. So we get their parameters of what they're looking for as far as property type, loan size, borrower requirements, and each one of those life companies has a little different requirements. Although they're pretty similar, they don't stray too far out of the box. They may occupy different sections of the box, but the box is pretty well defined. And then they tell us at the beginning of the year, hey, we're looking for loans from 1 to 3 or 5 to 15 or 2 to 8. We really like industrial, we like retail, we don't like office, whatever the requirements are. And we go out and through our contacts, Dave, repeat borrowers, real estate attorneys, brokers, a lot of the same sources that you guys go to find loans. We try and find those loans that fit those programs.
That's great.
Because they're very focused on what their program is, and because we've been trained, Patrick's still training, but I've been trained over 30 plus years. When we get a package in and do some basic underwriting, we can tell within about 24 hours if this is going to be a fit with one of those life companies. Because of those relationships, we might come back to the borrower, or in your case, the broker, ask some questions, kind of complete the picture for our correspondent. We're going to know at the end of that this is going to be a good fit for life company A, B, and C, or C and D. So we can kind of target those life companies. So we're not gunning it. We're not sending it out to 20 different life companies. And because we've already kind of pre-filtered it, those quotes come back pretty quickly. We can have a quote within sometimes that day, but usually within 24 to 48 hours. We received a package in today on a property in Scottsdale Air Park. Patrick and I inspected the property. Patrick did underwriting. I talked to the borrower about some questions and concerns I had. We talked to 3 life companies late morning. One was, send me it, I'll get you a quote tomorrow. So, and that quote with those life companies usually comes from the person who's has authority to provide that quote, and will have kind of a pre-approval with whoever's signing the commitment. So life companies are very, very flat organizations. They give a lot of responsibility and authority to our counterparts. They're very bright, smart people. And so, 99% of the time that turns into an app and closes per the terms of the quote. And I would even say that the 1% of the time when it doesn't, it's because the borrower usually has not told us something. Here's the rent roll, but the leases don't match the rent roll, or the borrower forgets to tell us he served time in prison, or
Right.
So,
Oops.
something that would jinx the deal.
Yeah. So basically, walk us through a little bit of what is a typical structure. Maybe talk about like the asset classes you guys like, and then, what's typical structure for, terms, conditions, rates, prepay, fees, et cetera, et cetera. Maybe
Sure.
walk us through that a little bit.
So the life companies, as a general rule, like what we call the 4 basic food groups. They like apartments, industrial, office, and retail. As you can imagine, in this environment, retail gets a little more of a cautious look because of COVID. But that doesn't mean we're not quoting retail deals right now. We have serviced and originated self-storage units, triple net properties, a Circle K or a Starbucks. They're not big on bars. They don't mind if a bar is in a retail shop, but they don't want that to be the only tenant. Because they're conservative companies, any of the budding medical marijuana or dispensary trade, it's just really hard. It's interesting, just a side note on that, over the last 5 years, we've noticed when we've talked to them, none of the life companies are against making a loan to that industry. They just don't want to do it until it's a federal legally on the federal level because of banking. They gotta go to the banks and collect their payments. Typically, life companies like 10-year terms with 20 to 25-year amortizations. They really, really like fully amortizing 10 or 15-year loans. Those are hard to find, but if a borrower is looking for something like that, that's a perfect fit for a life company. We have a couple of them that'll do 3, 5, and 7-year terms. I don't think a life company loan for a borrower is really good fit on a 3-year term. Maybe a 5 or 7, but not the 3s. But we can do those. We just issued a quote on a 15-20. So a 15-year term with a 20-year amortization on industrial in Tucson. The negatives and positives of a life company are that they fix the rate long term, and there is no ability to rewrite that loan based upon the borrower's financials or the real estate financials. Once the loan's on the books, if the borrower makes his payment, the life company stays out of their business. Occupancy can drop to 50%. At that point, the borrower will get a call from me saying, "What are you doing to right the ship?" But they won't rewrite the loan or mark the loan like banks will. So the fixed rate is very attractive for a long-term borrower. The negatives are that the prepayment penalty is yield maintenance, although we have a couple life companies that do the old-fashioned step down. But yield maintenance is kind of a standard, which is a make-whole provision.
Could you kind of explain yield maintenance a little bit, Tom? Just how does that?
It's legal into their quote, but on a life company loan, the borrower pays that outside. And those reports are going to cost anywhere from $6,000 to $12,000 depending on the lender. Legal is going to cost anywhere from $8,000 to $10,000 depending on the lender.
And could you give as best you can, like how does yield maintenance work from a layman's terms?
Sure. Yield maintenance is a make-whole provision. So let's just, for an example, let's say you borrow at 5 and it's a 10-year note, and after 5 years, the borrower wants to pay it off. The documents will then have language which looks to the U.S. Treasury market. There's 5 years left. Is 3%. Difference between the note rate and the treasury yield is 2, 5 minus 3. So that 2% times the loan balance times the remaining number of years is a prepayment penalty. The life company isn't actually going out and buying a 5-year note, but the prepayment penalty language looks like they're buying that note. And so you're making up the difference in the yield loss that they made in that investment. It's very important for those life companies to match that note to one of their liabilities, a series of insurance policies or annuities or GICs, something. If they're 10 years out, they want the investment to be 10 years out, and that's how they protect themselves.
So so if the bond market essentially is lower than the interest rate that they have for the term, then you're going to pay a handsome amount of the difference. If it's higher, then you just have the 1% prepay. Does that sound correct? You there, Tom? You there?
There's always a minimum of 1%. Yep.
Okay.
Yeah, I'm here.
Okay, sorry.
There's always a minimum.
Breaking up a little bit. So
there is always a minimum of 1%. But yeah, that it's all things static, all things being equal. If the bond market yields go up, then your prepayment penalty goes down. If bond yields go down, your prepayment penalty goes up. If the bond market never changes over 10 years, then your prepayment penalty would decline the longer you're in that term.
right.
So it's more expensive year 2 than it is in year 8.
So if I'm a borrower, we kind of understand the prepay, we understand the terms, 5, 7, 10-year fixed, understand the fee structure. Why would I choose a life company as opposed to walking into a bank? What's the distinguishing factor? Would you say?
The real benefits of the life company loan, Patrick just got done with his master's at ASU at WP Carey, and they had an interesting triangle on lenders, and life companies are that top peak of the triangle. That's the best money commercial real estate investor can get. Typically they're non-recourse, not all the time. Standard's always recourse, but typically they're non-recourse. They fix the rate for long-term, and they do not have any language which marks to market the note should they lose tenants or the borrower's financials go south. They truly stay out of a borrower's business.
And personal, like the recourse means that they're personally guaranteeing the loan. They're on the hook.
That's right.
Haywire.
Almost every bank has that.
Yeah. Right.
Every bank has that. The other thing is I think the other thing about the life company loan, and Dave, you experienced that with us over the years. If I get a quote, we're going to close. The banks, and just so you know, Dan, I sat on a bank board and the credit committee for about 8 years. A term sheet at a bank is, the LO's estimate of what he thinks he can do on a loan. That's typically not been approved by the credit officer or vice president of credit operations. It hasn't been approved by the credit committee. They don't have the appraisal. They don't have ...
Yeah.
So with a bank, there's all these levels before usually not until just before closing. With a life company, those terms rate are fixed at app, and then we proceed to close 45 to 60 days thereafter.
Yeah,
It's a level. Dave knows this. What we sell is certainty of execution.
At the certainty of execution, with a bank, Dan, they're going to look at global cash flow, they're going to look at the borrower, they're going to look at all these things, where the life company's looking at the asset itself. And obviously they're looking at their net worth and things, but they're not diving in and doing global cash flow and all the other nuances that banks do. And so they just kind of focus on that. Yeah, once they issue, it's like, boom, we're off to the races. So once you issue an application, Tom, what's the procedure for somebody. So they get this application, and then what do they have to do in order to get going and get to close?
So let me, if you don't mind, Dave, I just want to tell you kind of to Dan what we need to get to that app. It's usually a rent roll, borrower's financial statement, and a couple years historic income and expense. And we'll ask some base questions about the property, but it's pretty simple. Once we have a quote, if a borrower's interested, app is issued. App locks the rate when it's received signed back with 1 point. 1 point's a good faith deposit. Excuse me. Once the app's signed, then we get tax returns, copies of leases, credit report. Then we kind of get all the other things to back up that the initial presentation. Then it gets committed, depending on the lender, a week to 2.5 weeks after the loan app's signed. A second point is due with the commitment. And at that point, we order appraisal, survey, property condition, and phase one.
Now, how do you underwrite, Tom? What is your, just walk us through maybe your sort of credit box and how you guys are looking at, hey, we're going to proceed with this or not.
So we'll get the rent roll and the expenses, and we'll do some, we have a form, we do our risk analysis, our underwriting. All our lenders we probably are not going to underwrite to that 6 cap. So today the life companies are funding loans in the 60 to 70% of the market value of that property. The life company says that they're underwriting to a 75% loan to value, but that's their analysis of the value. So we just sent a package this morning in North Scottsdale. It is a 6 cap all day long in that market. Our life company at a 7 cap. It works both ways, by the way, so that's not an issue. But the life companies are going to look at underwriting different than appraisers, real estate brokers, and usually the investor that owns the property.
They're more conservative, and so they're focused on the LTV. They're focused on debt service coverage ratio that is what, probably 130, 140-ish range. Did the debt service coverage ratio around that 130, 140?
Yeah, but in today's market, we usually don't, we're usually seeing most of our debt service coverage ratios in the 150 to 160. That's usually not an issue.
Okay. Yeah, that's good.
Dan, just so you know, during the Great Recession, the banks and the Wall Street CMBS money, their delinquency rates were in the mid-teens, which was horrific. The life company industry never went over 1.5%. So they underwrite conservatively. They offer great rates, but they don't ever have a problem. That's their goal. They do not like problems, and they underwrite to that. So they really, really fit for that, wealthy investor, family, investment group that is buying a property and hey, we want to hold this for 10 or 15 years because we want to kind of clip coupons and everybody gets a check every month for the next 10 or 15 years.
Yeah. So then once they issue the application, they give 1%, which is your good faith deposit, and then you guys go ahead and lock the rate, and then what do they do from there? You have to go through and get an actual commitment letter about 10 days or so after that.
Yep. And then we order the reports and we close. The reason why the banks are subject to appraisals is because they're not great underwriters, so that appraisal is key to them. The life companies feel like they're good underwriters, and their history shows that. So we never get an appraisal in that is below our underwriting value.
That's good. And
and Dan, it's also important for your client to know that we order that appraisal. So
yeah, that's
I'm not saying that we order the appraisal to match our underwriting, but we send our underwriting to the appraiser.
Yeah.
And say, hey, this is how we're looking at it. Do you have any issues with this? And they don't. But
yeah.
There's a lot of communication. There's no issues typically with the reports.
Yeah, the reports are pretty clean. And so the borrower has the ability. Most of your loans have like a provision to, essentially assign the loan over to somebody else if they sell the building. Is that correct?
Yep. All the loans are assumable, depending on the letter. It's 1 point or 2 points. There's language in there for estate purposes. We just got a horrific call today about a young borrower who's in hospice. But the family's working through estate issues right now. But yeah, that's all, I don't want to say easily transferable, but it's dealt with pretty cleanly with life companies.
Okay. That's great.
And they don't call loans due because of that. That's important too.
And then nationwide, you can go anywhere in the country.
Did we lose you guys?
Are you there? Tom? No. Tom, you there? You there, Tom?
Yep, we're here. We lost you for a moment, Dave.
Sorry. So nationwide, you can go. You there? Oh, we lost. You there, Tom?
There, guys.
Yeah, I can. Can you hear me? Patrick, Tom?
Yep.
Okay. So
Yep, we're here.
Okay, so you guys are a minute or two. So nationwide, you can go nationwide.
We can, and not all our life companies allow that, but I would say a majority of our life companies, and certainly the ones we do the most business with, allow us to go nationwide.
And you, minimum loan size, $1 million?
Yeah, I think that's a good target. We've done loans as small as 400,000 or 500,000, but it's got to be a very compelling story.
Yeah, it's good. And you can go up to 50, 100 million, I suppose, if it was large enough.
Yeah, there's not a lot of those in Arizona.
Yeah, I know.
It's our average loan size is 1 to 4.
Yeah.
We do 5s and 8s and 12s, but
yeah,
80% of our business is 1 to 5.
Okay.
We are not real good, Dan. We're not real good with the owner occupied market. Life companies, banks are great at that. We have some of those on the books, but that we don't excel at that.
That's good. Well, yeah, I appreciate you taking the time. And so pretty much if Dan brings you a deal, you want to see a rent roll, P&L for a couple of years, maybe a PFS on the borrower, and then some information about the property, essentially.
Yeah, when it was built, the address, what they acquired it for or are in contract for, and what are they looking for? What's their kind of their investment horizon and goals? And Dan, at this point, this wasn't true 4 years ago, but if I travel because I see those life companies and I see a lot of loans, Patrick's at this point qualified to give you he'll check with me, but either one of us you can send a package to, and within 24 hours we'll get back to you. I think the one thing that I hope Dave has gotten to know over the years is we give you a really quick no.
Yeah.
And that's a horrible sales pitch,
Yeah.
but Dave is very efficient with his time. He's very focused on generating leads and getting business he can close. And so he calls us and we're out. Great. He's on to the next lender or bank or whoever he's taking it to. But if we're interested, we're gonna tell you really quickly. And if we get a quote out to you, we're gonna hound you every 24 hours to see why I haven't signed up. We're very focused on the business we can do.
Yeah, no, they do a great job. They're one of our favorite lenders because they, again, execution, follow through, delivery, it's all there. So they're definitely one of our favorites for sure. So we love working with you guys, and I know we've got more to come. And so we appreciate you guys taking the time today just to educate us on dealing with life insurance companies. And I know we'll be talking to you guys here shortly. So
thanks for your time, Dave, and it's nice to meet you, Dan.
Thank you. Nice to meet you too.
all right, guys, have a great one.